Hi, everyone. This is Jake Borbidge, Chief Investment Officer with Avidian Wealth Solutions. Joining me today, Robert Palmer, head of our financial planning department. We recently read an article in Barron's that we found quite interesting, talking about how many financial advisor firms are now owned, at least in part, by private equity investors. Robert, I know this is something that you've been paying attention to. What are your thoughts just off the cuff?
Yeah, I think it's really important for particularly investors and people that are looking at where to position their assets and who to trust to understand the differentiation between independent RIAs, which of course RIA stands for Registered Investment Advisor, versus those that partner with private equity. Independent RIAs typically have an open architecture. There's no quid pro quo with a separate entity. There's no outside sales pressure that comes in, and really the time horizons for the investments at an independent RIA are structured around the individual investor. And that kind of, in my view, provides a better glide path for ensuring that you're upholding that fiduciary obligation that you have with the client. However, there's the other side of the coin where you have private equity involved with an RIA. So they partner, usually it's a liquidation event where someone's trying to get a little bit of cash up front and bring in this additional party. And the reason why that can sometimes cause problems, at least according to the article, is that private equity tends to have a shorter time horizon than what RIAs typically like to position for clients. When it comes to clients, RIAs really want to focus on long-term investing, compounded returns, accumulating wealth, preserving wealth. Private equity, on the other hand, they look for short-term transactions. They look to see where there's a discount or some kind of arbitrage that they can execute on and capitalize on that in a few years. So you kind of have this differentiation between goals and aims that can ultimately cause a conflict. And I know that you do a lot of due diligence on private equity. What are your thoughts around this?
So I'd start off by saying there's a lot of value that private equity investors can bring to an industry, right? They have different industry expertise than the folks working in the trenches, but you get into a different alignment of motives, of incentives, where a firm that's independent, so let's clarify, a firm that's independent is not, it's still owned, right? It's typically owned by the financial advisor, by the individual that you sit across the table from, right? So the individual that owns the firm also understands your needs, understands your challenges, understands your goals as an individual, as a retiree, as somebody that's trying to plan your wealth profile. When you bring in another owner that doesn't sit across the table from you, their focus is going to be more on business results, right? And so it introduces a different set of incentives, and the incentive of a private equity investor, a lot of times it's around growth, right? And we can't grow an advisory firm, we can't grow an IRA without giving clients good results. So there is that side of it, which I think is aligned in most cases, right? Where we are aligned in terms of, growing the portfolio organically, getting you good investment results. Those are great things. A lot of times private equity can give us access to tools that we wouldn't otherwise have, especially if you're a really small advisor, less than $1 billion. The resources you have available to you might be very limited, but there's more than one way to get access to those tools versus just going straight to private equity. The other side of the coin, one of the motives that private equity is going to have in owning a business is to increase margins, right? You can increase the value of your investment by increasing growth, increasing the size of the pie, or you can reduce margins, reduce costs. Well, when you get into reducing cost, that's when you start to see resources disappear from an advisor, or you start to see things that are maybe a little bit less customized than what you're used to dealing with, a little bit more cookie cutter.
That makes a lot of sense, and I'm glad you highlighted some of the advantages. I don't mean to always be negative about there being a private equity partner. You have a great point about bringing in those additional resources that a smaller firm may not have. Jake, I'd like to take a moment to address some of the positives that a relationship with a private equity firm can bring to the table when partnering with an RIA. That being said, I think some of the positives can come from the structure of the relationship itself. If incentives are aligned and there's a good mutual understanding as to the fiduciary obligations, private equity can bring in fantastic resources and fantastic people to really drive business and a better experience for the client.
I totally agree. And one thing that you'll notice about the financial advice space, it's a good business model. And there's a good reason that private equity is invested in this space. So really it does come down to alignment of interests and alignment of incentives. If the private equity investors win when our fiduciary role is executed effectively and our clients are in a better position than when they join the firm, that's not a bad place to start. But picking the partner, aligning those interests, that's really the key and most critical component.
That makes perfect sense. But as I was going through the article, I noticed that a lot of these M&A deals involving private equity and RIAs, they have not been overly successful. It has not been very profitable for the private equity. And when they go in and make a purchase, they tend to be holding a lot longer than they want to. And that can, in my estimation, if your agenda is to capitalize on some kind of arbitrage or some kind of discounted valuation relative to what you feel you can make it worth, and it's not getting there in time, you could have that influence coming from that third party really pushing sales, really pushing in a direction that runs counterintuitively to the fiduciary duty that an RIA has.
I think you're right on the money there. What we do at Avidian is we're trying to build 10, 20, 30-year relationships with our clients. That might mean that there's some slow going early on. If your relationship horizon, some private equity investors may have this same alignment. If your relationship horizon is 3 years, that's not a very long time in the lifespan of a retiree, the lifespan of a advisor to client relationship. We want those relationships to be multi-decade relationships, not, half business cycle relationships.
And again, I think that makes sense too. I do see some of the advantages, when it comes to some of these larger acquisitions that have been in the news recently. I can see how it can help having additional resources for marketing, branding, and also pulling in maybe some Wall Street resources for better optimization of portfolio construction. But again, the private equity firm has its own investment agenda. It has its own portfolio. And so sometimes you might even find the RIA having pressure to serve as a feeder fund, or just something to drive, cash toward those investments. So there's sort of a mutual advantage between the private equity partner and the RIA. I mean, that's where I get worried, but I'm not extremely well versed on exactly what those pressures would be if that time horizon is exceeded.
Yeah, so I think what you're kind of dancing around a little bit is the opportunity to cross-sell within a private equity portfolio of companies.
Yes.
Right? And so cross-selling, a lot of times sounds great. It sounds amazing to the investor, right? To the owner of those businesses. If you can buy one business, you can buy another business and have the second business buy from the first business, you've created growth, right? So that looks phenomenal on paper to somebody that owns a business. However, to an advisor, the first thing that, kind of jumps into my mind is conflict, right? And Avidian, what we've tried to do is create a conflict-free zone where we want our advisors' only objective to improve the financial well-being of our clients. Nothing else matters here. When you own other types of products, they may even be really good financial products. You just naturally create incentives and biases towards those products, which, again, anytime you introduce incentives that are somewhat tangential to the fiduciary relationship between the advisor and the client, then you're creating incentives, you're creating reasons to deviate from that fiduciary responsibility.
So just to kind of circle back and wrap this up, I hear that private equity can bring in resources and some advantages, but, perhaps independent RIAs can go up against them just as well. So I know that you have developed a lot of resources here, as have I. I'd like to talk a little bit about how independent RIAs can compete when there's private equity resources that you're competing against.
So, yeah, I think that's a great way to think about it. What we want to do is we want to learn from the best in the business, right? And sometimes private equity, they have some really strong ideas about how to manage a business. And so when we look at it through Avidian's lens, we want to be in the sweet spot, right? We want to be able to offer the services to our clients that make sense, that help support their financial planning. Sometimes those services are not necessarily margin accretive, right? Sometimes they don't help us increase the bottom line for the owners of the firm, but if it's the right decision for the client, that's the decision that we're going to make. And that's where that fiduciary relationship blends over to the owner also being the fiduciary. A good example I'd think about is the investment team that we've built. There's a lot of expertise on that team, a lot of headcount, a lot of people, right? And so that creates cost for the firm, but it also supports our ability to make independent investment decisions for our clients, right? To execute that fiduciary relationship, to independently be able to evaluate what investment firms we want to partner with, which investment firms we want to avoid, and also to negotiate on behalf of our clients to get the best investment results at the lowest price. That's something where we think there are parallels. Private equity should be able to enable that as well, but just because we haven't taken on private equity dollars doesn't mean we don't have those capabilities.
Jake, I think that is a great point, and I can speak from personal experience that when I do financial planning, it's never a short-term time horizon. Goals might be short-term, but more often than not, we're looking at multi-generational planning. We're looking at how do we make sure this business empire continues its legacy, or how do we make sure this family continues to be wealthy generation after generation after generation. Now, that being said, I want to toss it back to you real quick because Avidian is a founder-led firm, and I'm kind of curious about your thoughts about founder-led firms.
So I think that point ties very closely into how multi-generational planning aligns with Avidian's business structure. Being a founder-led firm, there's a lot of research that supports founder-led firms naturally have strong business results. A lot of times they outperform their industry peers, but they're also put in a better position to plan for the long term as a business. And given that Avdian is a founder-led firm, that very much aligns and puts us in a really good position to succeed and provide great results for our clients as well.
Jake, I think this has been a great conversation. I think it's really important for investors and even existing clients to understand the differences between an independent RIA like Avdian versus another investment advisor that may have ties to a third party.
Robert, totally agree. It's been a lot of fun. I appreciate the time, and we'll see you guys next time.